Hi there, I'm Suyo Kulkarni, IT and Internet Analyst at Reliance Securities. Today we have initiated coverage on three mid-cap IT companies. First one is Mphasis with a buy recommendation and a target price of Rs 1200. Second one is L&T Infotech with a buy recommendation and a target price of Rs 2550. And third one is a Mindtree with a sell recommendation and target price of Rs 900. We have also released our industry research report, which suggests that medium-term demand for IT services remains resilient. I will start with the industry report and brief information about the IT industry. In FY20, IT industry generated revenues of $191 billion and employed more than 4.3 million people. IT industry comprises of three subsegments: IT services, engineering R&D services, and business process management or BPM. Geography-wise, the US contributes around two-thirds of India IT's revenues, followed by Europe and rest of the world. Indian IT industry, which flourished during Y2K crisis, has grown from $4 billion to current level of $191 billion. Currently, the Indian IT industry accounts for 55% of global sourcing market and almost 19% of the global IT spend. I'll discuss our key themes now. The first one is the medium-term demand outlook for IT services continues to remain robust. IT services or the software demand in the medium term depends on the two factors: level of economic activity, and second one is the pace of innovation, introduction of new technologies, and the business model changes. Currently, though the level of economic activity remained subdued due to COVID-19 pandemic, we believe there is a higher propensity among enterprises to adopt newer business models and induct digital technologies. Our second theme is Indian IT industry continue to gain market share. Indian IT industry grew almost at a 10% revenue CAGR since 2008. Its share in global IT spend has grown from 8.4% in 2008 to 19% in FY20. Currently, revenue from next generation services such as data analytics, cloud, customer experience, and cyber security contributes more than 30% of the 191 billion IT industry. We believe Indian IT industry continue to gain market share driven by proven track record in managing large transformation deals, availability of strong engineering talent in offshore geographies, long-standing customer relationship, and best-in-class methods and practices. Our next theme is travel, transport, and hospitality vertical is likely to witness the highest COVID impact. Our analysis of compilation of end market commentaries of key IT companies indicates that travel, hospitality, and transport vertical is likely to witness the highest negative impact. Retail, energy, and manufacturing vertical would also witness some pressure. On the other side, banking and financial services showing some signs of stability, while technology and healthcare vertical has witnessed some signs of strength. The fourth theme is the limited impact of H-1B visa ban. We expect the temporary suspension of H-1B visas likely to have limited impact in the tune of 20 to 50 bps on EBIT margin of the Indian IT companies. Indian IT companies have already stepped up their localization efforts and reduced the H-1B visa dependency. Currently, most of the Indian IT companies have 50 to 60% local employees in their US offices. Additionally, they have also stepped up their efforts on nearshore offices in Canada and Mexico. Next theme is the potential acquisition opportunities of captive units. Enterprises have increased their efforts for captive monetization, specifically where the parent company is under financial stress or captive unit which are not properly managed. During the global financial crisis and afterwards, Indian IT companies consistently remained active in captive acquisition. We believe it's a good opportunity for Indian IT companies to gain new clients and increase the wallet share among existing clients. Now, moving back to the stocks. Our first initiation is Mphasis. Mphasis is the seventh largest Indian IT services company and provide IT services to financial, insurance, telecom, logistics, and technology vertical clients. The first point of investment argument is its strong direct core business. Its direct core business clocked a strong 13% revenue CAGR over FY17 to 20, driven by new client addition and market share gain. We expect direct core business to clock 8.6% revenue CAGR over FY20 to 23 on the back of strong deal win momentum in FY20. Second is a limited DXC impact. DXC technology, where Mphasis works as a subcontractor and contributes 20% of the revenue, has witnessed slump in revenue growth and undergoing restructuring efforts. The near-term downside remains protected owing to the minimum revenue commitment of $300 million till next contract renewal in September 21. In the medium term, we believe strong core business growth story outweighs DXC concerns. The next point is the strong margin levers. On the margin front, higher fixed price contracts, offshoring and optimization of subcontractor costs are expected to aid in shrugging up pricing pressure in the medium term. Fourthly, there is a strong balance sheet and strong dividend yield. So Mphasis has a strong balance sheet with cash in hand of $325 million and strong dividend yield of 5%, which is the best among the peers. On a valuation front, we believe Mphasis deserves a multiple re-rating considering the industry-leading growth in direct core business, stable EBIT margin, and attractive dividend yield. Mphasis is trading at 20% discount to peer group, that is LTI, Mindtree and Hexaware versus 3-year average of 9% discount. We initiate coverage on Mphasis with a buy recommendation and 2-year target price of Rs 1,200 based on a PE of 15.8 times on FY23 EPS. We see 20% upside potential on current stock price. Our second initiation is L&T Infotech. It's the 6th largest IT services company in India and offers analytics and information management, enterprise integration, application management, cloud computing, testing and consulting services to global clients. The first point of investment argument is its growth outperformance. LT's revenue clocked a 15% revenue CAGR, which is 1.5 times of the industry average over last 4 years, driven by consistent new client additions and wallet share gains. Looking ahead, we expect LTI to maintain its leadership position on revenue growth front, driven by robust large deal wins, new client addition, and vertical focused client mining efforts. The second point is its diversified customer base. LTI enjoys a diversified customer base across geographies and verticals. A deep dive on LTI's top 20 US clients suggests relatively stable credit quality post-COVID-19 pandemic. The next point is strong leadership team. LTI has a strong leadership team with stable margin and healthy dividend yield, supported by a strong ROE, which is around 25%, make a stock a compelling investment argument. On a valuation front, L&T Infotech should continue to warrant a premium valuation versus peers on the back of its consistent industry-leading growth trajectory and execution-focused management, diversified client base, and robust new logo additions. We initiate coverage on LTI with a buy recommendation and a 2-year target price of Rs 2,550 based on a PE of 20.5 times of FY23 earnings with 13% upside potential. Our next initiation is Mindtree, which is now part of Larsen & Toubro Group, which provides business and technology solutions through its global offices and IT services to global clients. The first point of its investment argument is its low margin versus peers. Under the new management, while the Mindtree reported a strong margin rebound of around 800 bips since 1Q FY20, the broader margin continues to remain around 200 bips lower than the peers. We await the further clarity on margin trajectory and cost-saving plans to become more constructive on the stock. The second risk is its high client concentration risk. Revenue share from top client has grown from 11% in FY16 to 30% in 1Q FY21. We believe Mindtree's reliance on a top client for growth is unhealthy and it increases the client concentration risk. The third point is its high exposure to travel and hospitality vertical. Mindtree has reported 16% FY20 revenue from travel and hospitality vertical, which is the hardest hit during COVID-19 pandemic. We believe this vertical is likely to drag on revenue front over FY21 to 23. The fourth one is the deteriorating credit profile of the clients. Our analysis suggests the credit profile of key clients, primarily in travel and hospitality and financial services vertical, is declining, which we believe poses a medium-term credit risk and may affect the Mindtree's margins. On the valuation front, we believe current risk reward is unfavorable due to its high exposure to travel and hospitality vertical, disproportionate dependence on top client for growth, and limited clarity on medium-term margin trajectory. We initiate coverage on Mindtree with a sell recommendation and a 2-year target price of Rs 900 based on a PE of 14.5 times on FY23 earnings. We see 12% downside potential from current stock price. Thanks a lot. That's it from my end.